By not cutting interest rates this month, the European central banks made it clear to Eurozone governments that it's not going to solve the bloc's debt crisis. They have to do more. The benchmark cost of borrowing for the 17 Eurozone countries remains at a record low 1%, but still above that of other major economies. The ECB left its growth forecast for this year unchanged, but said the region is under increasing threat.
Economic growth in the euro area remains weak, giving rise to increased downside risks to the economic outlook. Ongoing tensions in some euro area sovereign debt markets and their impact on credit conditions are expected to continue to dampen the underlying growth momentum.
With increasing signs that Spain's banking problems are opening a new front in the debt crisis, Draghi was asked if the Eurozone's bailout fund, the European Financial Stability Fund, should be allowed to help Spain's banks directly. He hedged, saying that should be based on a realistic assessment of banks' needs, adding the ECB can't push governments into accessing the fund. At Draghi's news conference, the elephant in the room was Greece, which, depending how next week's elections there turn out, could be forced into a chaotic exit from the euro. Draghi also talked down the idea of the ECB injecting more money into the banking system, as it did earlier this year with low-cost loans, saying the issue is whether that would be effective.